appetite for ETFs just keeps growing, but why are existing mutual funds becoming exchange traded? This is Inside ETFs, and we're talking conversion. Increasingly, fund managers are taking their tried and tested strategies and turning them into exchange-traded products, hoping to get a slice of an active ETF market that captured 37% of industry inflows so far this year. Brian Krawez is president of Scharf Investments and has transitioned two of his own funds this way. Firstly, Brian, why? What does this allow you to offer to an investor?
ETFs offer a number of advantages, most importantly tax advantages. So because ETFs have a different way of being able to trade, we think there'll be significant tax advantages for investors, which will ultimately enhance their after-tax returns. So it's a really big benefit that way. ETFs also offer daily liquidity and more transparency for investors. So it's just a better structure overall than a mutual fund.
Now, your two ETFs are focused on where you see value. The biggest holdings include healthcare company McKesson, Union Pacific, Occidental Petroleum, but also Microsoft. So there's some big tech in there. What do those companies have in common?
Well, the common theme for us is we're really looking for very high quality company with predictable earnings. Right now, the market is really rewarding everything in AI and really a lot of speculative stuff, hopefully large growth. Which you may or may not get. With our companies, they're companies that have already been doing well for a long time, that have very stable profits, and that have stable growth. So we're a much more steady Eddie type of investment. And we think for investors who might have an overexposure now to AI and large tech that we offer a nice diversification benefit within an investor's portfolio.
This is slightly counterintuitive then, as money is so concentrated in growth stocks at the moment. Is there a space in the ETF markets for this? Because, as you say, everyone seems to want to pile onto a handful of already crowded trades.
Yeah, I mean, well, we had the largest active ETF launch this year, and our total conversion with the two funds was 900 million. So there's been a tremendous investor interest for our ETF product. Obviously, relative to the overall size of the whole market, it's a relatively small part, but we think there's a number of investors. We've had a lot of interest that do want to have some diversification and that are worried about the AI trade and wanting to not just have all their eggs in one basket.
Is there a risk, though, that you won't capture most of the upside if the market keeps on rising?
That is 100% the risk. If you look at our return profile, we've had our same strategy since 1983. Typically, when we lag, it's when the market is the most speculative and going up the most. However, on the down markets, we do very well. If you look at even the beginning of the year, when the markets were falling, we were holding up very, very well. So again, it's a nice diversifier for many investors' portfolios, and it's a strategy that we really believe in and one we've been following for a long time.
If investors are looking at these converted ETFs that were mutual funds, what should they be looking for? What could go wrong?
What could go wrong is, for one thing, if you have a mutual fund that's subscale, and it converts to an ETF, that's not going to really solve the problem of not having enough assets. And liquidity for those funds will be very light. And so investors, if you are interested in a smaller mutual fund or ETF that's active, you have to really be a long-term investor, because you might have an issue where the fund really doesn't have very high trading liquidity. And so you might have a liquidity issue. The other problem, if you've got a subscale fund that's sort of hoping to throw a Hail Mary and convert to an ETF, they may actually end up having to close or merge, and so an investor might not get what they think they're getting. And then there's potential tax disadvantages if an ETF or as a former mutual fund had to open back up, because it might have to close, and the investor would get hit with taxes. So there are some downsides, but for the most part, mutual funds converting to ETFs are in large part going to be very good for investors for all the reasons I mentioned before.
Is there a risk that once a fund becomes exchange traded, it might be too much leverage piling onto those trades?
Well, in theory, a mutual fund could have the same leverage, so that's really dictated by the strategy of the fund. I do think you're hitting on a very important trend, which I think is scary, is that a lot of ETFs are coming out with triple leverage or quadruple leverage or a lot of crazy things. That's in large part a difference in the industry, because there are a lot of smaller players. When you look at the mutual fund industry, there's a few large players like US Bank, where we're custody, that are more conservative and that are not going to really condone products with triple or quadruple leverage, but you have a lot of new players in the ETF space that are sponsoring ETFs, and you do have a lot of what I would consider very scary products. The reality is those what I call double stuff and triple stuff, where you can pick, instead of just having Palantir, you can have 3x Palantir. If you look in the actual prospectus of those ETFs, they actually show you that even if the underlying stock goes up a lot, you can actually lose money because of volatility. So I think a lot of investors don't understand they're not actually getting 3 times what that stock does. They're actually getting a derivative of that with a much worse return profile. So yeah, I think investors really need to be careful of these leverage ETFs and really stick to tried and true strategies such as our own that have really been proven the test of time.
That was Krawez of Scharf Investments. Don't forget you can watch more videos on Reuters.com.